Hi, and welcome to today's show where I have invited Stephanie Wickham from ExpatTaxes Ireland. Her firm specializes in cross border taxation and international taxation, especially with regards to expats moving into Ireland or moving out of Ireland. And we have invited her today to understand from the point of view of Irish entrepreneurs moving to Dubai, for example, and what would be the details of becoming a non-tax Irish resident. Thank you, Stephanie, for joining the show.
Thank you for having us on.
Yeah, and can you give me a brief background about yourself and your firm?
Yeah, no problem. So Expat Taxes, as you mentioned, is an Irish tax practice. It specialises in helping people who are moving to Ireland or away from Ireland with the tax issues that they encounter. And my background is I'm an Irish trained chartered accountant and chartered tax advisor. I trained with KPMG in Dublin, and I worked in Australia for 8 years in international taxes in over 20 jurisdictions. So on my return to Ireland nearly 5 years ago, we set up Expat Taxes, and to date we've worked with over 2,000 people, helping them with their tax issues that they encounter in the cohort I mentioned at the start.
Thank you for the introduction, Stephanie. So I'll get straight into the questions. Can you please explain to us what does it mean to be a non-tax Irish resident?
Yeah, of course. So that's a common question that we encounter when we deal with our clients. And I think the good news is that from an Irish tax perspective, tax residency is relatively straightforward because it's purely based on the number of days an individual spends in the Irish Republic in a given 12-month period. So to get granular with it, it's 183 days in a 12-month period or 280 days over the course of 2 years. So for example, with that second test, if somebody is in consecutive years spending 4.5 months in the country, they would likely exceed the 280 days, such that in the second year they're Irish resident. And there's also a carve out, which essentially is that if an individual doesn't have 30 days in Ireland in a given calendar year, they cannot be Irish resident. So routinely with our clients, we determine whether or not they're likely to exceed either of those tests. And if they do, then we can conclude whether they're going to be Irish resident or not in a given tax year. I think what comes up quite frequently is people tend to be aware from a quick Google search as to whether or not they're going to exceed either of those rules. But there's a second concept of residency that we have in Ireland, which is quite unique from an international tax perspective, and it's called ordinary residence. Ordinary residence can have the same or can create the same right for Ireland to tax an individual, and the concept there is that if an individual has been an Irish tax resident for 3 consecutive years, they become an ordinary resident. Once they become an ordinary resident, it takes them 3 years of non-residency to lose that status. So routinely we hear people asking us, well, I'm non-resident, but I'm ordinary resident, and what does that mean? So it's important that people understand there's two concepts, and while resident or ordinary resident, Ireland will retain a right to tax your worldwide income and gains in most cases.
Thank you for that. And can you also explain me what are the objectives a person tries to achieve when we say to secure a residency status of being a non-tax resident? What are the benefits of it, or what are the objectives, what we are trying to achieve with this?
Good question. Okay, so I think the initial point we'd make for somebody who's becoming a non-tax resident, so while ordinarily resident of Ireland, a non-tax resident remains taxable on their worldwide income in Ireland, save for employment income or income of a trade that is carried on completely outside of Ireland. So taking, for example, an Irish person who might be relocating to the Middle East for work purposes, once they break Irish residency, their ordinary residency position won't keep their employment income or their income from their trade in the Irish tax net. What's the objective of breaking residency? Well, the objective of breaking residency is to leave the Irish tax net for, I suppose, income and gains conclusively. What we find is a problem for people leaving is the ordinary residency piece. So I think the key answer to that question is breaking residency under the days test that I mentioned at the start is one item to consider, but an individual must consider when they are going to break their ordinary residency position if they want to rely on only Irish domestic legislation to relieve the Irish tax net for income and capital gains. I'll talk a little bit about the double tax agreement because that's obviously quite important when we talk about the UAE.
So can you now explain what are the processes and requirements of becoming a non-tax resident?
Yeah, so to break tax residency with Ireland, we have a self-assessment system, which essentially means that an individual self-assesses both their liability to tax and their tax residency position. So if we speak to somebody who's planning to maybe leave Ireland and depart Ireland to go and work overseas, there's a couple of steps we usually recommend that they take. The first is to maintain a travel diary. So that self-assessment system, we in honesty rarely see revenue querying unprovoked or without reason why somebody has declared themselves to be resident or non-resident. But notwithstanding that, it's important that somebody can have documents to support their claim. That would be, for example, maybe a travel diary. So they would keep a record of the days they've spent in Ireland and in the location overseas. We usually recommend that they retain evidence of passport stamps if available, flight records, and or bills showing that they were living outside of Ireland to support the non-residency claim. In terms of the claim and how it's made, it would be broadly, if they're required to file an Irish tax return, they would simply tick the non-resident box. And then, of course, they need to be cognizant as to whether or not that alone is sufficient to mean that they don't have to pay taxes in Ireland anymore. So I think maybe to kind of expand on what I mentioned at the start, the problem with the ordinary residency concept is that it counts as residency under the terms of the double tax agreement, OECD double tax agreements, which would obviously extend to the UAE double tax agreement. And the ordinary residency essentially needs to be cut through using the treaty to remove Ireland's taxing right on things like gains or income that doesn't come from employment or trade. So, for example, if somebody leaves Ireland, they declare themselves as non-resident because they are legitimately no longer spending time in the country. They remain ordinary resident, but they go to the UAE. They get a job there. Ireland, under our domestic legislation, won't tax them anymore because they're not carrying that work out in Ireland. But they may, for example, decide to sell shares the year after they left Ireland. Now, their ordinary residency will keep that in the Irish domestic tax net. In other words, they need to report that gain on their Irish tax return and pay Irish capital gains tax. This is when we need to look to the double tax agreement to see whether it will remove Ireland's taxing right. And I think my initial comment would be the lack of a taxation system in the UAE can make that difficult for us to do. So again, we always need to have a conversation with clients about the specifics, but it's important for listeners to understand that leaving Ireland for 6 months or 9 months is not necessarily going to be enough to break Ireland's right to tax their non-Irish employment income.
Thank you. So I do understand that you commented on a person moving to Ireland for the purpose of job and then getting an income from share sales. But I want you to expand on entrepreneurs who are moving to Dubai and operating the business from Dubai. So how does their income looks like if, let's say, they have set up a UAE company in a Freezone and getting all their revenues in that company, and their personal income would be a dividend from that company in UAE. So that would be the scenario. I understand that there is no personal income taxation in UAE at the moment, but we are introducing a 9% corporate tax. So in both of the cases, you have mentioned that a double taxation treaty under the OECD is very important in determining what the exact status is. So what's your experience in how do we read this double taxation between Ireland and UAE when in two cases, the company income and the personal income that is coming from dividends of that company?
Okay. The first thing I'd say is, for the purpose of this discussion, it's best to assume it's a trading company. In other words, it has an active business. It's not an investment company that just purely passively has income and acquires and sells assets. It's the first point. If we make that assumption, then I think it's good for me to explain the way it would work normally. So normally when somebody would leave Ireland and go to a country that we have a double tax agreement with, the ordinary residency can be, in most cases, disregarded. Why? Well, because the OECD model treaties generally say that when an individual is resident in two countries, so ordinary resident in Ireland and tax resident in the foreign jurisdiction, they become taxable only in the jurisdiction where they are residing, assuming they don't have a home in Ireland anymore. The issue we have potentially with the UAE is that the double tax agreement between Ireland and the UAE says that the treaty is applicable when the person moving to the UAE is resident there and liable to tax, or liable to tax by virtue of residency. So I suppose the point that I'm making is the lack of a taxation system in the UAE could mean that the treaty is not in play. Now, my personal experience is I haven't seen revenue challenge that, but I suppose my viewpoint is there needs to be caution there. That's the first point. The second point would be, let's assume the treaty does provide protection. Let's assume that the individual can rely on the double tax agreement. Perhaps there is a corporate tax and or income tax being levied in the UAE, and I acknowledge the second point there hasn't even happened yet. Well, then the ordinary residency falls away because the individual will treaty tie break to the UAE. The UAE gets sole taxing rights. From a dividend perspective for the individual, that's likely going to mean that a dividend paid from the UAE to an individual who is resident in the UAE is no longer taxable in Ireland, notwithstanding the fact that they remain ordinary resident. In terms of the corporate entity, in other words, if an individual has incorporated an entity in the UAE, there's no reason for Ireland to lay claim to taxation of the corporate profits on that entity if we assume that the corporate entity is not carrying on business in Ireland and it's not being managed and controlled from Ireland and it doesn't have a place of business in Ireland. So I suppose broadly the comment would be, it is very possible for people to break residency with Ireland and leave the Irish tax net. However, it needs to be done with planning and with reference to their individual circumstances, as well as the fact pattern that would match what the entity and they themselves are doing in the foreign jurisdiction, the UAE included.
Thank you for the answer, Stephanie. So my next question is about the timelines of achieving the breaking from the tax residency in Ireland. So assuming that a client wants to start on this process, and what we do is we can set up a Freezone company in Dubai and issue a UAE residency in 2 months from now. So now the client has moved to Dubai. He has a company in Dubai and a long-term residency. That's for 2 years. He has that residency in Dubai as well. So, but what does the entire timeline looks like in terms of the planning phase that would need before moving to Dubai, then putting the structure in place in Dubai that, as I said, it's 2 months, and then how long further it needs before the person is able to break from the tax residency in Ireland?
Yeah, that depends really on the income source. I think the first thing I'd say is a useful domestic relief that we have that I always recommend that clients take advantage of is called split year relief. And split year relief is essentially a relief that applies domestically if the individual is leaving Ireland to go and work overseas. So, for example, if they have Irish employment income and they take a job in Dubai, it could potentially be with their own company. If they leave Ireland and they go overseas, they can lodge a split year relief claim before they leave with the revenue commissioners. If they're planning to be outside of Ireland for more than a year and the application is accepted by revenue, then their post-departure employment income is not within the Irish tax net. In other words, they can essentially stop being taxed in Ireland on their employment income from the date that they leave. And there's certain conditions around that. To break residency such that it applies, that logic applies to everything, is slightly more complicated. The split year relief only applies to employment income. To break residency for an individual, it depends on the time of year that they leave. So using the fact pattern that you gave there, my question would be, well, what part of the year have they left Ireland? And in the year after departure, how many return visits do they have planned? Because we do tend to speak with people who potentially would like to maybe spend winter in the Middle East and summer in Ireland. And that can really make it difficult for residency to be definitively broken, especially in the year following departure, because of our 280-day look-back rule. So I would recommend that clients always take advice 6 to 9 months before they plan to leave. And if they leave it that long to take the advice, they need to be cognizant of the fact it may take time before Ireland loses the right under our domestic legislation to tax their worldwide income and gains.
Thank you, Steph. Now, my next question connected to the same idea is, what's the process of informing the revenue about this change?
Good question. So in Ireland, there's no automatic reporting requirement from the individual's perspective to tell revenue that they've left. We do have tax information exchange agreements and cross-border reporting. Of course, that's not for the individual to worry about. It's more done at international tax office level. The individual, if they have an obligation to file a tax return, they are required to tick on the box whether or not they are a tax resident, whether or not they are ordinarily resident, and whether or not they have an Irish domicile. And domicile is a tertiary concept that we have here in Ireland that can keep or remove certain income and gains from the Irish tax net. Probably a podcast for another day. But if somebody leaves and they have no filing requirement, in other words, they have no investment income or gains that are taxable in Ireland, leaving Ireland of itself does not give rise to the obligation to file a return. What we see with most people who are, for example, employees in Ireland is they don't have a filing obligation. In other words, they settle their taxes at the year end, and that's essentially a true-up of taxes withheld via payroll. They can claim more credits, and if they don't claim them, well, no harm done. They don't have an obligation. Where we see other clients who take advice from ourselves are maybe individuals who have an Irish company, they own shares in the company, they're a proprietary director, they have to file an Irish tax return. And depending on the circumstances, in the year of departure, they're going to need to indicate on that return whether they are resident or ordinarily resident in Ireland. So it can really depend, is the short answer. And I would recommend that if somebody's unsure, that they seek advice from a professional tax advisor.
Continue with the requirements aspect of becoming a non-tax resident. I understand that you have mentioned travel diary, to maintain a travel diary before, but can you explain more on the concept or the idea of how can we prove that someone has left Ireland and has a permanent place of residency somewhere else? Are there any other requirements in addition to the travel diary, or how does that work?
Yeah, so I suppose one thing we could always look to produce, and we have provided to revenue before from the UAE, is a tax residency certificate in the UAE, which, if I am not mistaken, is available. It's interesting that we have a double tax agreement with the UAE and that tax residency certificates can be generated there. That is something that I would always recommend my clients apply for, and it's not going to hurt to provide it to revenue in terms of demonstrating that they have taken up residence elsewhere. Other things that we generally advise clients to retain, because arguably they will have them anyway: copy of a rental agreement in the foreign location, evidence of utility bills paid there, perhaps a foreign driver's license. We don't routinely see revenue requesting this type of information, but if for some reason we want to demonstrate that somebody hasn't been in Ireland, it is very useful for us to be able to show that they have a life elsewhere. In other words, they have become a frequent stay, or have a frequent stay in the overseas jurisdiction. So generally we find that a foreign tax residency certificate is sufficient. I suppose I'm just cognizant of some of the points I made earlier about whether or not it's in play or applicable. Therefore, if we're looking to just demonstrate that the individual hasn't been in Ireland, these other ancillary documents would be helpful in that way.
Sure, thanks. And can you also explain if there is a concept of exit taxation in Ireland? Like if someone at the day of becoming a non-tax resident, is there any final tax they have to pay? And if there is, how does that looks like? What happens with that?
We don't have an exit tax per se, like some other countries like Canada and Australia have. I think the more important point there would be the concept of, as opposed to an exit tax, a retention of right to tax. What I mean by that is, if we think about what ordinary residency is, it is an ability for the Irish Revenue Commissioners to continue to tax you for 3 years after you have left the country. That's what it is in simple terms. And that of itself could be thought of as an exit tax. In other words, if you leave Ireland and you affect or liquidate or take part in a transaction, you need to think about the Irish tax implications of that for 3 years after you've left the country. So it's not what we call a formal exit tax, but I suppose it can be thought of as a form of it. In terms of exit taxes, we do levy them, but we levy them on residents and ordinary residents alike. So one exit tax that can apply to ordinary residents as well, and it applies to residents equally, is an exit tax that applies on certain overseas investments. So in Ireland, we have a tax regime that's called the offshore fund regime, and it essentially applies an exit tax every 8 years to growth in the value of certain investments. For example, EU ETFs, certain index funds, mutual funds are generally caught by this regime. That exit tax will kick in, and it could impact somebody who is ordinary resident of Ireland and is no longer living here. So I think the short answer is we have nuanced exit taxes, but we don't have a formal exit tax regime like other jurisdictions do.
Sure. So, as you said, once a person has left Ireland, and if he is still an ordinary resident, he or she can be taxed for up to 3 years. Now, my question would be, if you have formed a Freezone company in Dubai, does that Freezone company also has to report income and pay taxes in Ireland as long as the ordinary residency stands, or is there a way that we can avoid that?
So we do have anti-avoidance, where individuals who have gains and potentially income in overseas investment companies, the anti-avoidance can kick in. Ignore that. Let's talk about trading companies. Assume the Freezone company is carrying on a legitimate trade, trading in the Middle East, and managed and controlled in the Middle East, board meetings in the Middle East, incorporated in the Middle East, with no activity in Ireland. No, there's no right under either international law or Irish domestic law for a foreign company that's trading legitimately outside of Ireland to have any tax exposure in Ireland, assuming the individual isn't sitting in Ireland running the company on a day-to-day basis. So no, the profits within that company wouldn't fall within the Irish tax net, assuming no links with Ireland. I'm focused more, the ordinary residency is more applicable when the individual wants to extract money from that company. So going back to what I said at the start, obviously if the individual extracts employment income, that isn't taxable once they're no longer a resident. However, if they decide to take large dividends from the Freezone company, Ireland will, under its domestic law, retain a taxing right to those dividends for 3 years. Beyond the 3-year period, that falls away. But assuming we can't invoke the treaty in the meantime, then there's very little we can do about that. So the message is, if you're going to Dubai and you plan to incorporate a company, take advice in both jurisdictions, because ordinary residency will, in the first case, keep you in the Irish tax net for 3 years after you leave.
Sure, thank you. That's a very important point that you've said. So we do have a structure in Dubai where we essentially employ the owner within the company, and that has a fixed salary that is reported to the Ministry of Labor as well. So we have a contract, employment contract, and it would show a fixed salary. And the owner has the choice to pay that salary in the monetary terms or not. It's not mandatory by the Freezone, but there is an employment contract and there is a salary in place. So what I can be certain from this conversation is that at least that part of the income that they would draw as a salary would stop being taxed right away, and then the dividends would continue for the 3 years period.
Potentially. I mean, what we would try to do
Yeah.
is invoke the treaty if we can. I suppose I just want to put a question mark as to whether or not revenue would accept that if they did scrutinise it. But we routinely can invoke the treaty in other jurisdictions without any problem, because there is tax regimes there. So the UAE is just an outlier in terms of the fact that it's tax free for individuals. But I agree completely with what you're saying. And I spoke with a client the other day who was planning to set up an import-export business in the Middle East. They would definitively be carrying on all the activities outside of Ireland. So in terms of, I suppose, Ireland's right to tax companies that are not managed, controlled, run, based in Ireland, it's just not there under domestic or international tax law.
Sure, thank you. And changing the subject a bit more. So assuming that if a person has a personal property that they were living in Ireland, and then once they have moved out, they've tried to rent out that property and then started a rental income. So does that rental income continues to be taxed, or how you will be able to treat that?
Definitely. So, if an individual is renting a property in Ireland while they're living overseas, their filing obligations continue. Revenue have recently introduced a new regime that essentially is trying to ensure that non-resident landlords are meeting their Irish filing obligations. The way we see this being done most frequently is by way of a collection agent. Collection agent is essentially just somebody who's based in Ireland who pays 20% of the rent across to revenue by way of prepayment of tax on a monthly basis. So this only became effective from the 1st of July 2023, and like all new schemes, it's perhaps in its infancy in terms of being able to address every scenario. But notwithstanding that, the concept is this. Yes, you are living outside of Ireland and you have an Irish rental property. Every single tax treaty I've ever seen will always give taxing right for rental income to the state where the property is located. In other words, Ireland will never lose the right to tax that income. That is not to say that it's not taxable in the jurisdiction where you're resident. Of course, in the UAE, that wouldn't be the case. But anyone listening to this who's living in Australia, the US, Canada, needs to be cognizant of the fact that they have potentially a tax liability in two locations. However, credit for the Irish tax is generally due in the foreign state.
Sure, thanks. And what about if a person decides to sell that property at one point while being a non-resident landlord? What could be the implications of that?
So the first thing is it's a chargeable gain. In other words, analysis needs to be done to see whether or not a capital gains tax bill arises. We do have CGT here in Ireland, and there's various reliefs and exemptions that might reduce that or extinguish the tax liability fully. So, for example, somebody's lived in the property as their main home for the entire period of occupation, say for the last months. Ireland generally won't apply capital gains tax to the sale of your main home and 1 acre of land. But most people, if they've left Ireland, they've rented the property for a few years, they need to think about their capital gains tax bill. And Revenue have become more savvy at ensuring that tax bill is met before the proceeds are released to the client. So, for example, what we see is a lot of solicitors will often look for capital gains tax clearance before they release the funds to the non-resident landlord or the non-resident vendor. So it does pay for people living overseas who have Irish properties to keep their local property tax, their income tax, and their capital gains tax affairs up to date, so that if they do go to sell an Irish investment property at some point in the future, there isn't a delay on having funds released to them.
Sure, thank you for clarifying that. So can you tell me about some common misconceptions that people have when they start to become a non-tax resident in Ireland?
It's a really good question. I think we hear a lot of phrases that can kind of lead people to the wrong tax payment, the wrong tax outcome. So it's very common for non-residents to think that if they pay tax in a foreign jurisdiction, they never have to pay taxes in Ireland. Just to revert back to what we said earlier about the rental income, it's very common for people to think, well, if I pay tax on rental income in a foreign state, I no longer have to pay it in Ireland. That is not the case. They also tend to think things like, well, there's a double tax agreement in place, so if I pay taxes in Ireland, I don't have to pay it in the foreign jurisdiction. Also not true. It depends on the income type, the gain type, and when it happens, and residency rules in both jurisdictions. But in terms of becoming non-tax resident, I suppose the most common misconception we would have is that people tend to think that if they haven't been in Ireland for 183 days in a given year, they can't be a resident. And that's not the case, because the 280-day look-back rule is designed to counter somebody leaving Ireland for 6 months of the year, coming back for 6 months, or leaving partway through the year and breaking residency. So they're the three main ones that we would see. Again, there can be many more aside, but they're the common ones.
Sure, thank you. And if someone wants to engage with your services, especially with regards to an entrepreneur, business owner moving from Ireland to Dubai, how does the process looks like? And from the start of the initial discovery call, and what's the period where you're figuring things out, and then eventually they're moving to Dubai, and how are you engaging once they have already moved to Dubai? So what does your process looks like?
So I suppose we tend, perhaps are outliers in the sense that we don't do discovery calls. We tend to collect information from clients in advance of the consultation. And our aim really is to limit the number of consultations insofar as possible. The reason we can do that is because we have a lot of experience in this area and we've worked with a lot of different people in different situations. So the situation normally is that somebody would send a brief inquiry to our website via our contact us form. So our website is ExpatTaxes.ie. We obviously vet the queries that come in and we'll recommend the duration of consultation that we think they need. So it can vary from 30 to 45 to 60 minutes. The aim usually with most of those calls is to try and provide guidance and clarity. The reason we can do that is because we send a questionnaire in advance of the call, we ask them specific questions, and we discuss the key issues on that first call. Following from that, we can then offer written advice if needed and or tax compliance support. And usually we can also offer an introduction to a foreign advisor if they're moving to a location that we have a partner in and we can identify that they likely need input there. So we tend to offer quite an all-in-one service whereby we, rather than trying to have prolonged discussions and we try to be as efficient as we can with that first hour. It's not always possible, and particularly if there's complex corporate structures that need analysis. But if somebody needs tax residency confirmation, application of the double tax agreement to their situation, and suggestions as to what they should or shouldn't do, an hour is usually sufficient for us to provide that.
Sure. So can you tell me what are the steps after that? Like how does it proceeds?
So usually if we have a consultation, we will give the client some action points or things to think about. We can make a recommendation then that we can provide written summary of the key issues discussed or a written advisory note that will outline some of the key opportunities and risks that we might see. And there can be both opportunities and risks in every situation. The other thing that we would usually do as well then is recommend support for people who maybe have Irish companies that they are going to work for or no longer work for when living overseas. We can provide tax return support. I think that probably the best answer to that question is it depends. Because what we tend to find is we have clients that fall on a spectrum of relatively simple tax affairs to complex investment portfolios with corporate structures that need analysis. So really, we offer a bespoke service. Our online consultations are booked via the website. The aim where possible is to provide this support in that hour. However, there's many clients who we go on to work with as a partner. They can put us on a retainer and we're there to kind of support them as they navigate breaking residency, triggering residency in the foreign jurisdiction, right through to reporting their income and gains to the Irish Revenue in their annual tax return.
Sure. Thank you, Stephanie. And my last question is that if someone wants to work with you, what are the ways that they can approach you or contact you, please?
Awesome. Well, we have our own podcast, which I think you will hopefully appear on for us soon, called Tax Bites for Expats. And that is a podcast that a lot of our clients listen to before they contact us, because we tend to try and cover key issues that are commonly asked for by our clients. The best way to contact us is to go to our website. An online booking can be made for a consultation in real time at a time that suits the client. We do all our consultations online via Zoom, and essentially there's no need for us to meet face to face. We have to go through a anti-money laundering verification, and that's all done quite easily through an online application, and that can be installed on an individual's phone. But yeah, info@expatTaxes.ie is our email if people have specific questions. But we also have blog posts on our website. We have customer stories of people who we've helped, and we have a video on our website as well, which explains what the consultation process looks like. So our website is the main resource for anybody who wants to initiate contact or isn't sure if we can help.
Sure, thank you. And for sure, we will have the links to your podcast, website, and the email address in the description of this video for anyone who wants to easily approach you. But thank you, Stephanie, for joining us, and it was a very informative session.
Thank you for having me on, and I look forward to hearing from anybody who might have questions subsequent to listening to this episode.
Sure, thank you, and I wish you have a good day.